All right, so divisional performance, sorry, economic value added, that's what we have, economic value added. Anyways, it's also under performance evaluation in your PM, all right? So in some materials, in some textbook, you see it under divisional performance management, where you have your ROI, residual income, then economic value added. So I'm taking economic value added as a standalone topic, so you understand, because sometimes when ICAN is setting EVA, I can set it as a standalone, all right, giving you sufficient information for you to provide solution to EVA. Does that make sense? Now, it's interesting to note that this particular question was examined last diet, but in a different dimension. Now, before I will end the class for tonight, I'm going to tell you how it was tested in last diet and how our students were able to do exploits. Now, because it was tested last diet, it does not mean that it would not be tested this diet, because last diet, I think, was the first time I've ever seen an EVA question tested in that nature. I can dash you guys mark. So going forward, they may not give you that pattern. They may give it again to the normal pattern that they usually use. Now let's explain what EVA is. I have this note showing on my screen. So if you have your pen, that will do you justice. I will just summarize these notes. Then we'll take about 3 questions, 3 to 4. We're starting a little bit early, so we should be able to finish up at least 3 or 4 questions. Okay, now everybody here are accountants, isn't it? Everybody here is an accountant, and everybody here knows how to prepare profit and loss accounts according to how you have been taught in financial reporting. Everybody knows how to prepare profit and loss account. Now, let me just tell you the story behind EVA. Okay, Stewart was the one that introduced EVA. There's a company known as Stewart. Okay, they were the one that introduced economic value added. I wish I saw your name. I would have just kicked you out immediately. Okay, so everybody knows how to prepare profit and loss account, and the profit and loss account that we have been preparing is actually in line with what international financial reporting standard states, or what is it actually in line with what you have been seeing in your financial accounting materials or financial accounting textbooks. That is to say, if you are given a question on how to prepare profit and loss account, you know you're going to put in your sales, cost of sales, other expenditures to get your net profit. That is the financial accountant way of preparing your profit and loss account. Now, when you come to economic value added, position your mind on the economic way of doing things. That is one thing that you must note. That is why it is called economic value added. So we are looking at the economic perspective of actually preparing your profit and loss account, because economics believe, not just economics, even accountants also believe that one of the objectives of a business is to create value for shareholders. And one of the ways that you can create value for shareholders is to ensure that the profits, okay, that is the economic profit that is left, is able to pay the shareholders their returns, and you still have excess. So if you have a profit of 5 million naira, for example, and your shareholders' returns, which is like dividend, okay, that they are receiving, or interest, whatever they are receiving, is 3 million. That means your profit of 5 million minus your shareholders' return, which is dividend of 3 million, will give you an excess of 2 million. Then you can say that what value has been created. So economic value added talks about a scenario where the company is able to measure the performance of managers to check if managers have actually done their jobs very well in such a way that they have added value to the shareholders of the organization. If you don't add value to the shareholders, what's going to happen? These guys may pull out their fund. Okay, this guy may feel like they are wasting their investment or putting their investment on a wrong soil. So we are trying to check the best way, okay, the best economical way by which we are able to maximize the returns of shareholders, or by which we are able to make more profit that will be able to pay off the returns of shareholders. And in one way that we are able to do this is by using economic value added as an indices for measurement. Now, let me go back to my story. If you now understand the fact that we are trying to look at the shareholders' perspective and how we can actually pay them their returns and have excess in our accounts, then you must understand what we mean by economic value added. Now, under economic value added, 2 things are involved: the accountant way of doing things, the economic way of doing things. Because what ICAN is going to give to you is what the accountant has actually done. What you'll be left to do is to convert what the accountant has done to what the economist would have done. So what ICAN would do is that ICAN is going to tell you that, look, oh, based on the profit and loss account that has been prepared by the financial controller or the financial accountant, this is the profit that we have gotten. Am I making sense now? This is the net profit, or this is the operating profit that we have gotten. Now, the question is, this profit that has been gotten by the financial accountant, is it a realistic profit? I and you know that the profit and loss account that you get in the profit figure that you get in your profit and loss account is not realistic. Why? Because it has undergone so many kinds of adjustments which are not realistic. Okay, because it has undergone what, so many kinds of adjustments which are not what, realistic. Does that make sense? So they are not realistic because you have deducted depreciation. Depreciation is a non-cash item. It is not a real transaction. You have deducted provisions in your profit and loss account. Provision is just an artificial transaction. It is not a real deduction. You have made so many types of deductions in your profit and loss account: impairment losses, revaluations. Okay, you've done some kind of adjustment to your profit and loss account, which are just by virtue of the law, which is the IFRS that guides accounting, but they are not actually realistic transactions. So imagine that you just saw that, okay, an asset has been impaired, you calculated the impairment amount and you included it in your profit and loss account. In reality, that asset may not be as impaired as you have computed it to be. Imagine that you've computed depreciation of 500K on an asset, okay, on a company's asset. In reality, that asset may not have depreciated up to 500K. All these things are just the accountant's way of keeping transactions. Now, from the EVA perspective, EVA is saying that I do not trust the figure, which is the profit figure that you have gotten in your profit and loss account under the accounting treatment. I am going to convert that figure to the economic part of it, or let me convert that figure to a realistic figure. So what we are simply doing under EVA is that we are going to be given a profit and loss account by ICAN, and that profit and loss account, 99.9% of that profit and loss account has been prepared in accordance with a financial accounting perspective. So all you will need to do is to convert that profit and loss account to the economic perspective. Now, if you do taxation, the way you used to do computation of adjusted profits, when you have your accounting profit and you give it to the tax authority is going to convert it to adjusted profit, meaning that there are some things in your profit and loss account that they don't even like. They don't want to hear about it. It doesn't suit them. It doesn't fit well with them. They are going to adjust that thing. That's what we mean by adjusted profit in your taxation. So the same thing comes to performance management. So when the financial accounting department presents the profit and loss account to the performance department or the management department, what they're going to do is that they're going to convert a profit and loss account to EVA, economic value added, which is the figure that they believe is more realistic than your profit and loss account. Now, the question is, how are they able to convert this figure that belongs to the profit and loss account of the profit and loss account prepared by the financial accountant to this other figure that belongs to the economic value added prepared by the performance manager? What do they do? Now, they will check your profit and loss account as you have prepared it according to the financial accounting perspective, and they are going to make many adjustments to it. Please note that when Stewart released this theory on economic value added, there are over 260 adjustments that we can do to an EVA question. ICANN cannot test an EVA question that has over 260 adjustments. It's not possible. So you will see at least 5, 6 adjustments in your exam max. They don't really go too much. No, the adjustments in your account may be up to 8, but they are not really different from each other. They all have different pattern of arrangement or different pattern of adjustment when it comes to the EVA perspective. So just know that in real life, you can adjust your financial statement as much as possible according to the rule of EVA. As summarized in your ICANN pack, you're not going to be given too much adjustment, okay, based on real life scenarios. So I'm going to be giving you those adjustments that you would see in your examination and how you are able to overcome them. So let us move to int in solving an EVA question. So coming down, you will see something like this. Okay, this is my material. So let's see. Okay, this is it. Now, in solving an EVA question, the first thing you need to understand is that the formula for EVA is actually NOPAT, because it's EVA is equals to net operating profit after tax, which is NOPAT, then minus capital charge. Okay, net operating profit after tax, which is NOPAT, minus capital charge. That is the formula to compute EVA. Okay, That is the formula to compute EVA. So when you see your net operating profit after tax, when you have computed it, please remember that that's your net operating profit after tax is the adjusted profit for EVA purpose. Remember that you'll be giving an accounting profit. That is not the net operating profit after tax. So that accounting profit that they have been given to you in the question, you are going to convert it to NOPAT, which is the profit that is reasonable for EVA computation. So for you to convert it to NOPAT, you're going to make those adjustments that we're going to be looking into now. It is when you have applied this adjustment to your accounting profit that you now get NOPAT. So once you get your NOPAT, please minus your capital charge. Okay, minus your capital charge. Remember, I told you that EVA talks about is a kind of atmospheric situation where a company is able to realize so much that it is able to pay for what the cost of capital, which is what returns on what capital. So this NOPAT is what the company has realized for so much. Okay, I don't know the amount, maybe 15 million, 10 million, 15, 12 million, whatever. That is the meaning of NOPAT. What the company has realized in reality. Then this capital charge is talking about what we are going to pay to our equity holders, what we're going to pay to our debt holders. Because when a company makes profit and that profit is not enough to pay the providers of capital, it means that the company has not actually created value. Please take note of that. The company cannot create value if what it gets in terms of profit cannot pay its shareholders. But a company is creating value when what it gets, in this case, NOPAT, is able to pay for what the shareholders' returns. In this case, it is known as what? Capital charge. So capital charge simply means the returns, what those things that the shareholders are expecting. Debt holders, shareholders, which are equity holders and debt holders, what are they expecting? Don't forget that your shareholders are expecting dividend, okay? 10%, 9%, 12%, whatever is the rate. Your debt holders are expecting interest, okay? So combined, these are all the expectations of our what? Shareholders. So we are going to take it out. If we still have a figure that is left, that means that the company has created value. But if we don't have figure that is left, maybe we're having a negative figure, it means that the company has not created value. I am saying this because I can give you an EVA question and tell you to interpret the answer. So if you don't understand what I am saying, you may not be able to interpret the answer. When your EVA is positive, meaning that when your NOPAT is greater than your capital charge, it means that the company has added value to shareholders. There's a lot of money, okay? When your NOPAT is lower than your capital charge, it means that your company has not added value to shareholders. Shareholders may get angry, they may withdraw, stuff like that may happen. Now, the question is, how do we calculate NOPAT? I've already told you we are going to make some adjustment to calculate NOPAT. Then let's move to how do we calculate capital charge. Now, capital charge actually means weighted average cost of capital. Okay. Capital charge actually means weighted average cost of capital. Weighted average cost of capital, please mute. Please mute. Weighted average cost of capital is simply, remember I told you that capital of a business is provided by two sources, the equity holders and the debt holders. So when you combine both sources of capital, you have to look for the average. Okay, that's why they call it weighted average cost of capital. The cost of capital is the returns that the equity holders will take and the debt holders is going to take. Then we'll look for the average of it. So we're going to say WACC, okay, which is a weighted average cost of capital, times net assets. Okay, net asset is simply the capital that the shareholders has contributed. So for all the capital that they have contributed, what are they expecting in return? So if they have contributed 100 million, then what are they expecting? Equity holders is expecting 5, debt holders are expecting 3. So that's 8. So look like 8% of what net asset. But that 8% we're going to look for the average anyways. I'm going to show you how to calculate average. Now, if ICAN wants to make life easy for you, ICAN will give you the WACC, which is the weighted average cost of capital directly. Okay, they will just tell you that the weighted average cost of capital is 10%. So you are just going to apply the 10% on the net asset figure. All right. But if ICAN wants to make life a little bit difficult, you will not be giving the weighted average cost of capital rate directly. You would have to compute for it. And I'm going to show you the formulas that you would need to compute for a weighted average cost of capital. The next thing that ICAN will want to do to make life difficult for you is that they may not give you net asset directly. Okay, they would not give you net asset directly. In many cases, we would have to adjust for net asset. In many cases, I repeat, in many cases, 90% and above, in fact, 99.9%, we will always adjust for net asset. The normal theory is that when you are adjusting your profit and loss account, you will technically adjust your balance sheet because of the double entry principle. So what goes to your P&L automatically goes to balance sheet. And remember that your net asset is a balance sheet item, and your profit is what? A P&L item. So if we are adjusting the profit and loss account prepared by the accountant, definitely there should be an impact that would also go to the balance sheet through the net asset. So that is why I said in many cases, your net asset would always be adjusted. So if I can give you a net asset in a question, in as much as you are adjusting the profit and loss account, you would technically adjust your net asset at the same time. This topic is quite very simple. If I am grading this topic, I would wonder, or I am wondering why ICAN is putting this topic at skills level. This is supposed to be like 1B, okay, in a standard secondary school, all right, because this is not difficult. Now let us move down and see how we can adjust for no parts. Please write down the rules. How do we adjust for no part? Let me give you the rules. Remember I said that you'll be giving the profit of an accounting of the accountant, and you have to convert the accounting profit to economic profit. Now, what are the rules to convert accounting profit to economic profit? Rule number one. Rule number one. Disregard depreciation. I get it now. In essence, just say disregard non-cash items to make life simple for you. Disregard non-cash items. Example of non-cash items are your depreciation, your impairment, your provisions. Those things are very common. Okay, so your P&L account, you are going to add them back. Why are you adding them back? Because they have initially been deducted by the financial accountant, so there's a need for you to add them back. Now you're going to add back your depreciation, you're going to add back your provisions, you're going to add back your impairment if given. But please, I want you to be careful, be very careful. Please be very careful. The depreciation, let me explain that part of it. Now, depreciation has what we call accounting depreciation and economic depreciation. The depreciation you see in your profit and loss account prepared by the accountant is an accounting depreciation. This should be added back. In case you're not seeing the additional information, they not told you that they not told you that economic depreciation is 10 million. That means that if you add back your accounting depreciation, you have to go and deduct the economic depreciation. Let me explain. The economics is believing that that depreciation that you computed under the accounting rule is not realistic. So they have gotten the real figure for depreciation. So you go and add your own back. Let me deduct my own. Am I making sense now? But in some cases, they would also tell you that accounting depreciation is the same as economic depreciation. In some cases, they will not even give you economic depreciation at all. All you just need to do is add back. Don't bother. Am I making sense now? That is the twist for what? Economy for depreciation. Am I making sense now? Then, for that non-cash item, there are some times that you may be giving non-cash item directly on your financials. Okay, in the question, they'll give you non-cash item. Anytime you see non-cash item, please add it back to your profit and loss account. And also go and add it to your capital employed. Anytime you see non-cash item, anytime you see provision for depreciation, if you have added them back to your P&L, please go and add them back to your capital employed. I told you, whatever adjustment you are doing to your P&L, it will necessitate another adjustment in your balance sheet. So when you are adding back a non-cash item, when you are adding back provision for depreciation to your P&L account, you must also come to your net asset, which is your balance sheet, and also add those figures back. Let us take a practical example. If we have provision for depreciation in our P&L account as an expenses, do you know that in your balance sheet, when you are doing your current asset, when you have your debtors, you must have also said debtors less provision for what? Bad debt. Am I making sense? That is what if you are very good with solving financial statements and they gave you a standard financial statement question and there's provision for bad debt or provision for doubtful debt, if you have deducted it from your P&L account, you would also need to deduct it in your balance sheet under debtors. Do you agree with me? So because you have deducted it in your balance sheet under debtors, there will be a need now because you have added it back to P&L account. You must also go and add back to the net asset perspective. I am giving you these rules. They may not be explicitly stated in your textbooks, but please take note of that. If you have non-cash item, if you have provision for depreciation, as you have added them back to your P&L account, please go and add them back to your balance sheet through the net assets. Am I communicating? Okay, next rule is that One-off items, okay, one-off amount. One-off items are those items that do not occur all the time. Okay, they are transactions that do not occur all the time. Now, if you have a one-off transaction in your P&L account, you have to either add them back or subtract them. Now, let me give you an example. So, profit from the sale of an asset. A company,
Sir, excuse. I didn't
please,
hear the
you
last
are
word.
supposed to raise up your hand. You are interrupting my class. Who is that?
It's me, Chidima. The
Okay,
last after the, I didn't
please,
hear the last explanation you did
you
because
see,
the network was actually breaking.
and I believe it's only you. Okay, so please let's take that. I think what was I talking about? Was I talking about the depreciation part? If you have a non-cash item and you have a provision for for bad debt or provision for doubtful debt in your account, okay, if you have added them back to your P&L account, you should also add them back to your net asset in your balance sheet. That is the rule, okay? Add them back to your net asset in your balance sheet. Then after that, I now mentioned, so I said we have what we call one-off item. One-off item are those items that occur once, sometimes in 5 years, 6 years, you may not see them again. And I said, an example, company that sold one of its assets. When you are selling one of your assets, you don't sell assets all the time. Your normal business is to sell pure water or bottled water. Then this year, you now manage to sell one of your old water making machine. You don't sell assets all the time. And because you don't sell assets all the time, the profit you make from selling the asset, it will be wrong that you just include that amount in your profit and loss account like that. So EVA is saying that why would I include such an amount in my profit and loss account when those things does not occur all the time? That is what we call one-off item or unusual item. If, look, that's number C here. Okay, so you are going to what, add them back. If you have deducted them before, add them back. If you have added them before, deduct them again. Okay, like loss, when you make loss, you must have deducted it, so go and add it back. Once you have made profit, you must have added it. Okay, so go and deduct it back. Does that make sense now? So please let me come back with the rules. When you are adjusting an accounting profit, economic profit, you must remember that you will see something related to depreciation. Please add back depreciation. And I told you something about depreciation. I said we have accounting depreciation and economic depreciation. If the question tells you that economic depreciation is so amount, you go and add back your accounting depreciation first and deduct the economic what depreciation, because that economic depreciation is more realistic than your accounting depreciation. I also give another scenario that sometimes they may not even say anything about economic depreciation. You just go and add back your accounting depreciation directly. Forget about it. Okay, good. Then I now mentioned that, okay, there are other two things that I can usually test. They usually test non-cash item in the question and provisions in the question. When you see non-cash item and provision, add them back to your profit and loss account and deduct and also add them back to your net asset in your balance sheet. Everything is settled and plain. We're going to solve questions. So you're going to be seeing the reason why I'm saying all these things. Okay, you're going to be getting an insight, more insight about why I'm saying all these things. Then I mentioned also that we have what we call one-off item. And I said that one-off item are those items that do not occur all the time. You are selling an asset. Will you sell an asset next year? Will you sell that asset again next 2 years? No. So what happens is that when you are dealing with a one-off item, you are going to add back that item, because if you have made profit on that item, you add it, you will do what? You add it back, isn't it? If you had made a profit on that item, you added it in your profit and loss account, so you go and subtract it. If you have made a loss, you have subtracted it before, you go and do what? Add it back. So it depends on what you made when you are dealing with that non-cash and when you are dealing with that one-off transaction. Does that make sense? Now, going forward, there are some expenses that are not actually expenses in reality, but they are treated or they are seen as an asset. So, for example, when you see in your question advertising, okay, marketing, promotion, research, development, this or what we call staff training. Are you getting it now? These items are actually treated as expenses in your profit and loss account. But under EVA, the rule is saying that we should amortize them. We should not treat them as an expenses. We should treat them as an intangible asset. Why am I saying this? Pay attention. Marketing. Your company incurred 5 million naira to market a product. Please, will they get the value of that marketing in only that current year? That is the question. Your company invested 5 million naira for what? Marketing. Now, will your company only get the value of that marketing for that current year? No. That marketing, that advert that you have done, next year, somebody else will still see that advert and order for your product. Next 2 years, somebody else can still even see the advert and market your and get your product. So most of this expenditure have future benefits. So according to EVA, okay, according to EVA, any money that you are spending that has future benefit. Look at staff training now. If I train my staff in 2020 or 2025,
what is that necessary? Because it was that complaint that we are the one that is
okay,
spoiling this.
all right,
All
all right,
right.
all right. Thank you very much. So look at staff training. Now, if I train my staff in a particular year, does that mean that my staff will only be productive in that particular year? No. That training will impact into their future world productivity. Therefore, any expense like marketing, promotion, research, development, staff training should be amortized. Staff training should be what? Amortized. All right. So anything like that should be amortized. Now, what does amortization simply means? Now, let me explain what it means. Okay. Let me explain what it actually means. Now, if I have incurred, for example, I have incurred 5 million naira for advertisement, and I was told that that 5 million naira for advertisement is going to bring benefit to my company for 5 years. According to the accountant, normally they would have just expensed that 5 million naira to their profit and loss account directly. I say, let's just take it out. There's no need for us to spread it over the 5 years. But EVA is saying that in as much as that expenses or that particular cost that you have incurred is going to bring benefit into the future, please spread it. That spreading that we're talking about is amortization. It means that 5 million naira advertising expenses divided by 5 years, that will give us 1 million. So in this year that we incurred it, we're going to put 1 million there. Am I making sense? In next year again, we're going to put 1 million. That is every year we're going to be putting 1 million until we exhaust the 5 years. Please don't forget, if you incurred 5 million naira for marketing and advertisement, and this year you put 1 million in your profit and loss account as an expenditure, the other 4 million naira will be going to balance sheet, isn't it? As what? As a what? As a current asset, isn't it? For next period. Next year again, if you liquidate 1 million naira into your profit and loss account, what will remain? 3 million will be in your balance sheet, isn't it? As what? Current asset. Because it's an asset to you, isn't it? That makes sense. That is amortization. So amortization is more or less like you are spreading the cost of an asset, mostly an intangible asset, over the useful life of that asset. And in the process of spreading it, a portion will be recognized in your profit and loss account, while the balance will be recognized in your balance sheet. Does that make sense now? So please take note of that. That's another idea regarding to treatment of EVA. Then I think every other thing. Now, when you see lease is one part that I can usually include. In fact, ICAN and lease, they have gotten married. They married at ICOI registry. Lease. Now, when you see lease in the examination, am I making sense now? When you see lease in the examination, you are going to add it to your net assets. Especially when they tell you that the lease, there's a lease rental, there's a lease payment of 10 million naira. You are going to add it to what? To your net assets. Why? Now, according to EVA, operating lease, all lease are treated as finance lease. Okay? All lease are treated as what? Finance lease. Therefore, when you see lease in your exam, please capitalize them. Capitalize simply means you should add it back to what? Capital what? Employed. Please don't forget that capital employed is the same thing as net assets. Okay? So EVA treats all leases as finance lease. So I don't need to be explaining what finance lease actually means to you now. So please take note of that. When you see lease, please add it to your balance sheet. That is your net asset figure. Okay? Then if you have any lease charges in the income statements, this should be added back and removed from no part. Now, let me calm down. Lease simply means rent. Understanding that way, rent. Rent. If you have in your P&L account, they tell you that lease payment, that means rental payment in your P&L account, please go and add it back. Am I making sense now? Go and add it back. That is to say, lease, okay, that is in your P&L account should be added back because the accountant must have deducted it as an expense for that particular year. Please go and add back your lease because according to EVA, that lease that you see in your P&L account is an operating lease. And EVA does not recognize operating lease. EVA only recognizes what? Finance lease. Therefore, finance lease should be added to capital employed. That's the rule. Go and read your IFRS. Am I making sense now? So we are going to add it back to your P&L and also add it back to your capital what? Employed. Does that make sense? In principle, the depreciation should then be charged on the asset acquired under what? Finance lease. Now, if EVA gives you the economic depreciation of a finance lease, that is the lease that will now what? That's the amount that will recognize. But however, ICAN has rarely tested that scenario I don't think I've seen it for a very long time. We've not seen that for a very long time. So please, when you see an EVA question in your exam, it is quite very simple. What are you looking at? Please work with the formula. Okay, work with the formula. And according to the formula, we said that the formula for EVA is simply what? NOPAT minus what? Capital charge. Your NOPAT simply means that you're adjusting your accounting profit to economic profit. While your capital charge, you need only two things for your capital charge. Okay, you need three things. Okay, you need three things. You need your net asset, which is known as your capital employed. Okay, and you know in account your net asset is fixed asset plus current asset less current liability. That's your net asset. I will come back again. Your net asset is fixed asset, what you call your non-current asset, plus your current asset minus current liability. Don't go and go. If they give you a question and you're not starting calculating nonsense net asset, and you just go and lose your math to ICAN. That is the formula for net asset. If you know your FIRS very well, then you also need your cost of equity. You need your returns to equity holders and your returns to debt holders. Okay, that is what you need. I'm going to be giving you a rule in EVA that many students find it difficult. In fact, I have received calls on EVA because ICAN will solve one question on EVA today. The next diet, if they test EVA, the solution is different. And then we'll be asking, why is ICAN contradicting itself? ICAN is a king when it comes to accounting. They are not contradicting themselves in this case. There is a rule that many students do not understand, and it is not expressly stated in the textbooks. I have researched key textbooks in Nigeria. None of them have that rule. I'll be giving you that rule free of charge today. In case you see two different solutions to EVA, you will not begin to ask yourself, why did they solve it this way? Why did they not solve the same question again this other way? Why are they not following one pattern? Please, it is not a mistake. It is an hidden rule that I'll be exposing to you in today's class. Stay with me. I'll be solving this question first, okay? This first question. Let's apply the rules that we have learned so far in solving this simple question. Now, calculating EVA, that's the first question that we have, okay? Now, please pay attention. Please pay attention. Pay attention. Sorry, let me see. Okay, so pay attention. Now, they said a company has reported operating profits of 21 million. Now, let me mention it because this is going to lead us to the rule. When I told you that they are going to give you a profit and loss account, you are going to adjust the profit of that profit and loss account. One thing that I did not tell you is that I did not tell you the actual profit that you will be adjusting. Because in your P&L account, you'll be seeing things like profit after tax, profit before tax, operating profit. Then you will say, Dr. President said we should adjust profit. But the question is, which profit are you adjusting? That is the secret behind EVA. You can adjust any profit. I repeat, you can adjust any profit. But the issue that you may have is that when you add any of those profits, the rules are different. So if you are adjusting operating profit, it's different from when you are adjusting a profit after tax. It is both two different ball game entirely. I'm going to be teaching you how to adjust profit before tax when the question tells you that there's an operating profit before tax, and when the question tells you that there's an operating profit after tax. I'm going to teach you how to adjust for both of them. So in case you see it anywhere, you will not be confused. Am I making sense? A company has reported operating profit of 21 million. We don't know if it is profit after tax or profit before tax. Abi? But normally, we know that operating profit sometimes is profit before tax. Makes sense, Abi? Sometimes when you hear the word operating profit, sometimes usually profit before tax. Then when you hear the word profit after tax, okay, there is part. You know, this profit tax has already been deducted. So in this case, I don't want to assume, but I just want to read for that and see what we have. Now, This was after charging 4 million for development and launch costs. So we have an operating profit of 21 million, but this 21 million, before we got the 21 million, they had $4 million for development and launch cost of a new product that is expected to generate profit for 4 years. I'm going to explain this, but in my next question, you'll be the one to be doing the explanation. But let me explain this one now. Now, because this 4 million naira belongs to development cost, and it has been proven in the question that this development cost is expected to generate profit for the company for 4 years. What did I tell you? I told that if a company incurs, those expenditures are meant to give the company future benefits. According to the rule of EVA, what do? We amortize it. We do not expense it. So this 4 million naira has been deducted as a whole sum in our profit and loss account before we got 21 million. Therefore, we will go and add this 4 million naira back to that 21 million because that treatment is wrong. Then we will now divide that 4 million divided by 4 years to get for this current year, which is 1 million. Isn't it? We will now treat that 1 million as development expense for this year. Then the other 3 million will take to the balance sheet. Let's go and rest there in the balance sheet till we get to the next year. Am I making sense? Am I communicating? You may not be able to unmute. I think I've locked it. I don't know. So if you want to ask questions, please use the chat box. I may unmute you if you want to ask any questions so you can ask your question. I repeat, there's a $4 million development cost, which is going to last for 4 years. What the accountant did was that he expensed the 4 million. That is to say, he took out the whole 4 million from the P&L account. This is wrong according to the rule of EVA. According to EVA is stating that because this expenditure has the capacity to generate revenue for the company in the future, please go and divide it by that number of years. So $4 million, okay, divided by 4 years. That means we have 1 million for 1 year. The other 3 million, take it out. Okay? The other 3 million, take it out and take it to get balance. Am I clear? I need your response, please. Let me know I'm communicating. Just from the chat box. Am I clear? I want to state another important rule. Are you clear with this? Are you clear with this?
Yes, sir.
Thank you. Now, another rule that I need to tell you that is not stated in a textbook. If there's any textbook that has that rule, I've not seen it. Maybe you can see it later. Okay? Now,
Excuse me, sir.
Who is that?
Not a fact.
Okay, please proceed.
Okay. Are you saying that this 4 million now, when we divide it by 4, that's 1 million for each year or 1 million for all the 4 years?
1 million each year for 4 years.
Okay, sir.
Thank you. This is economic value added for somebody that is asking. This is economic value added. Now, please, this rule I want to tell you now. Jot it. If you're writing textbook in the future, include it in your textbook. That's your selling point. That is your selling point. I can tested 2 questions in EVA. The 2 questions are similar. In fact, very close. They look like twins, but the solutions are different. Let me tell you what they did in that question. I'll tell you one thing that they did in that question. Now, it is clear here, Abby, that there's a $4 million for development, and the 4 years was expressly stated in the question. In some questions, they will tell you that that the company incurred $4 million for development costs, which is expected to generate future cash flows, but they will never tell you the number of years that cash flow is meant to last. Then you will not be confused. You will not say, ICAN has made mistake. Why didn't they give us the number of years? Hi, who said this question? Rubbish. ICAN, this. It's a lie. It's not a mistake. Please, if you are not giving the number of years that an intangible asset is meant to last, leave it like that. Do not amortize the whole amount. Use the whole 4 million like that. I have spoken. Yes, you see it. Do not go and do 4 million divided by, because you don't even know the number of years. So what are you doing divided by? Am I making sense now? And that is not a mistake on their part. They are only trying to test whether you know the rules that guides this thing. So since there is no number of years back there, forget about it. And do what? And add back what? The 4 million. Does that make sense? Just add back the 4 million like that. Let's proceed. We may end up seeing a question like that as we proceed. Or when you start solving from your end, you'll get to see questions like that. but I just have to spell out these rules because they are not expressly stated. Okay. Please, I'll come back to your question. I'll come back to you, Black G. Thank you. Taxation is paid at 25% of the what? Of the operating profit. That means that this operating profit that we have here is actually operating profit. What? Is it before tax or after tax? Is it before tax or after tax? We're going to come to that. That's the first question we're asking ourselves. This operating profit, is it before tax or after tax? Please go ahead with your question. Thank you.
All right, thank you very much. It's just to get a clarification for the one that using the lease you spoke about for 4 years. Now it is just the one. It's just the one. The first year own we are adding back, which is the 1 million. That 4 million you were talking of. Is it what you said that we only add back the one for that particular year since we are amortizing it? I need you to just get clarification for that.
This is not a lease. This is a development expenditure, which is meant to bring in future revenue to the company. And I said that you incurred 4 million for development, and they told you that the 4 million will last for 4 years. Go and divide it and amortize it, because the development cost is going to last the company for future years. It's going to generate profit for the company for future years. Then I made a second point, which is a fact in their solutions, that in some cases, you may be given the 4 million as development cost or marketing cost or training cost, but they will never give you the years. Okay? They will never give you the years that is going to cover. All right? Now, if they give you the years that is going to cover, which is the same scenario that we have here, they're going to say 4 million divided by 4 years, that is 1 million. That is to say, we are going to say 1 million is development expense for this year. The remaining 3 million is deferred for next years and years to come. It's just like depreciation now. I guess now it's just like provisions. So if you are doing accounting very well, you understand that when a particular amount, when somebody pays for rent for 6 years, you are not going to put the whole 6 years rent in your P&L account. You are going to divide the 6 years rent by 6 years to get 1 year rent. It is that 1 year rent that you're going to put in your P&L account. While the remaining 5 years rent, you call it deferred rental payment or deferred rental income. Isn't it? For 4 years. That's the same thing that we are doing under this theory, under development cost. So if you are given the number of years that development cost is expected to last, please divide it by that number of years. Pick that answer that you get as the current portion, then defer the balance. But if you are not given the number of years, there's nothing for you to divide. I get me. Just add back your 4 million direct, because you know you have subtracted it before. Add it back direct. We're going to see question on that, and you're going to understand what I'm trying to say. But this is just this is an question we are going to solve, and I'm going to see how simple this is going to be. So please, from your end, the rule is that you are going to mute, or I mute you and take you out. Please, if you are just coming in, mute. That's our rule here. Okay. Thank you. Then I was asking a question. I said the question has stated that taxation is paid at 25% of the operating profit. And I said, does that mean that the operating profit given to us in the question above, which is 21 million, is actually before tax or after tax? We are going to come to that, okay? If you have your answer, please state it on the chat box. Let's debate on it. You are all professionals. Let's debate on it. So let's go further. Let's go further. Now look at this. The company has a risk-adjusted weighted average cost of capital. Please, whenever you hear the word risk-adjusted weighted average cost of capital, that is WACC. Don't let them use stories for you. That is what WACC. Okay, that is WACC. So that's what we mean by risk-adjusted, okay, weighted average cost of capital. What's wrong with my pen? Okay, so that is WACC. So we already have our WACC, isn't it? We already have what? Our WACC. Let's go ahead. Then they now told you, and is paying interest at 9% per annum on a substantial long-term loan. The loan amount of which they didn't tell us anything about. Am I making sense now? So just keep that at the back of your mind. So the company is paying an interest of 9% on a loan. Loan amount we don't even know. Don't worry. Now, this is another part. Look at this part. It's a very simple question. The company's non-current assets value is how much? 50 million, isn't it? And the net current assets have a value of what? 22 million. Remember, I told you that you will need net assets whenever you are solving for EVA. And I told you that the formula for net asset is what? Fixed asset, Abi, FA, Abi. So let's see. So we have fixed assets. Oh, sorry, I think I'm having this with my pen. So fixed asset plus, so let's say current asset, isn't it? So current asset, then you minus what?
Minus
What do you minus? Current
liability.
what? Liability. Answering me. Oh.
Current liability.
Thank you. Now, what is fixed asset in this question? The fixed asset in this question is your net, is your non-current asset, which is what? 50 million, Abi? Good. Are you seeing it? This is the 50 million. Okay, 50. Please don't mind my pen. No. 50 million. Let's manage it for today. Then who can tell me my current assets? Based on what you can see from the question. What's your current assets? What are we giving? We are giving net current asset, ba? So net current asset simply means current asset minus current liability. That's what it means. Financial reporting students. Net current asset simply means current asset minus current liability, which is 22 million. 22 million. So they've given us the answer already. So normally we are just supposed to add both. Just add both together. When we add both together, we are going to get our what? Net assets. Does that make sense? But look at what the questioner said. The questioner said that the replacement cost of the non-current asset is expected to be 64 million. You have already given us a non-current asset before of 50 million. Why are you not giving us another non-current asset value of 64 million? According to the rules of EVA, where multiple figures are being given to you with respect to non-current asset, aka fixed asset, the one that you will use is the replacement cost of that asset. No juju can change it. If they let them give you historical cost of the asset, if they let them give you net book value of the asset, if they let them give you Shingbang cost of the asset, they also give you replacement cost of that same non-current asset. Please leave every other thing and pick the replacement cost. That is the cost that is most realistic for that particular asset. So in this case, we are going to neglect this 50 million naira, that $50 million that is given to us in this question. All right, and we are going to replace it with 64 million. That's what we are going to make use of. Please, any question before I proceed? Any question before I proceed?
No, sir.
Thank you. All right, so let's go ahead. Let's go ahead. Okay, some people are already saying profit before tax, profit before tax. Thank you very much for that. All right, let's solve this simple question. Let's solve this simple question. I think I should have my solution here. Okay, that's fine. Okay, so please focus your mind here. This is the focus your mind here. Okay, focus your mind here. Now, illustration one. What is that? Okay, illustration one. Now, that illustration we just read, I said step one. I have highlighted the step that you can use to solve an EVA question. Step one, because the EVA formula says NOPAT, which is net operating profit after tax, minus what? Capital charge. So the first thing I would like to solve in this question is for me to even get my NOPAT. My NOPAT means my adjusted profit in simple terminology. NOPAT. Am I making sense now? Now, I told you that whenever you are solving your NOPAT, you must start with the accounting profit. The profit that is presented to you in the accounting financial statement. But we are not sure which profit is given to us, because if you are starting with profit after tax and you are starting with profit before tax, they are both different ways of doing things. So in this question, the operating profit that is given to us is profit before tax. So please, you are learning how to solve EVA, starting with what? Profit before tax in NOPAT computation. This operating profit is profit before what? Tax, because we have not yet removed tax from this profit. 21 million. Let's go and confirm in the question. So we have the company has reported operating profit of 21 million dollars. Okay, this was after charging 4 million of development cost. So let's go ahead. That's why we recognize what 21 million here. Now the next thing we want to go ahead is that what are those things that will affect this 21 million? We are told that there's a development cost that has already been deducted from this 21 million before. We say, wow, development cost 4 million naira. Okay. What does that mean? That means that they have wrongly treated this development cost. So please, we will go and add it back. That's what I did here. I said add development cost. This 4 million, I added it back. Are you seeing it now? Then I remember that this thing will last for 4 years. So this year that we're talking about, let us take the portion of this year out. And I said development cost was amortized. Again, $4 million divided by 4 years. That means 1 million will be coming towards this year. You know, there's still a balance of 3 million. That 3 million will take it to our balance sheet. So calm down. Apart from that, there's nothing again that will affect our profit and loss account. Taxation, taxation is there. Is there any other expenses that we have not treated? Is there anything like depreciation? Is there anything like marketing? Is there any expenses in this question? No. The only expense that they gave us in this question is developmental cost and taxation. Those are the two. They mentioned something about interest. 9% per annum on a substantial long-term loan. We don't even know the amount. So, bagbe, forget about it. I get it now. Forget about it. They cannot frustrate us. So we don't know the interest. So let's forget about it. So the last thing that we need to do is to say, okay, 21 plus 4 is 25. 25 minus 1 is 24 million. So we now said tax of 25%. Tax of 25%. So they told us that the tax of 25% is on what? Please look at it here. Let's read it very well. Not be solving blindly. They said taxation is paid at 25% of the what? Operating profits. So in our solution, what's our operating profit? Our operating profit is 21 million. So please, somebody should do 25% of 21. You will get 6 million. Can somebody point? Four. What do you get? You get 6 million. Nobody came with calculator. 25% of 24 million. Okay, that's 6 million.
6 million.
No,
6 million.
that's 6 million. 24 minus 6 is no part of 18 million. I told you that before you attend this class. Hold your calculator and get your jotting paper. 25% is taking 2 minutes. All right. So 24 minus 6 is what? 18 million. That's our no part. We've gotten our no part. The next thing that we need to do is to get our net assets. Because the question has already given us WACC directly, which is our weighted average cost of capital. How many percent did they give to us? They gave us weighted average cost of capital of 12%. So there's nothing for us to compute there. It's already given to us expressly. So we need to go and compute our net asset. When you hear the word net asset, we're talking about those figures that will affect your balance sheet. And we've already computed it here. These are formula for net assets. So what we'll be picking is our 64 million, okay, and our 22 million. Isn't it? So let's go back to our solution. So you have your replacement costs of your replacement costs of your non-current asset is 64 million. Replacement cost of your non-current asset is what? 64 million. So I said the replacement cost of the non-current asset is 64 million. We are using 64 million. We cannot use the net book value. I've told you that before. Then your net current asset, what it means is current asset minus current liability already, which is 22 million in the question. So now, that 3 million that we have left under developmental cost, okay, which I said add back development cost for future period. That's what I call it, add back developmental cost for future period. So we have 4 million minus 1 million, giving us what? 3 million. So our net asset is what? 89 million. Does that make sense now? So when you have your NOPAT, you have your net asset, and you have your WACC. So life is now easy, isn't it? So the final step in your NOPAT, in your EVA, is step 3. Compute for EVA. What's our NOPAT? 18 million. What's our net asset? 89 million. What's our WACC? Given to us in the question as what? 12 million. So 12% of 89 million will give you 10.6 million. 18 million minus 10.6 million will give you EVA of what? 7.32 million. This means that the company has added value to shareholders equal to $7.3 million. Am I making sense now? Then, why are we having this? Okay. So that is what it means. Now, what am I making? What is the point I'm going to make out from this particular solution? Please note that in this particular solution, we started with operating profit, which is profit what? Before tax. All right. As we proceed, I'm going to also treat profit after tax and how you can also treat questions with regards to that. I'm going to be giving you the rules. Okay. I'm going to be giving you the rules. Let's look at another question. Let's see what we have. I think we are done with this finally. Let's see another question and see what we can do. Okay. I have this. Let me see. Okay. I have this revision question. Now, the income statement for Beta Co for the year ended 31st December 20X1 showed the following. Now, we are given $650 million as operating profit. I hope you are still with me. We are giving operating profit 650. We had to take out interest. We now got profit after tax. Profit before tax, sorry. Okay. Then we had to take out what? Tax. We now got profit what? After tax. So now, maybe in exam situation, you may be confused if nobody told you. Because you may be asking yourself, which profit am I to adjust? All right, because you're having so many profit here. We have operating profit, we have profit before tax, we have profit after tax. Now, you may decide to start with any of them. Any of them that you are starting with has different methods. Does that make sense now? So let me see. I think I started with operating profit here. That is to say, profit before what? Tax. Please note, whenever you hear the word profit before tax, it is also profit before interest and tax. Financial reporting students, profit before tax is the same thing as profit before interest and tax, because you must remove interest before you remove tax. Am I communicating? Good. So in this case, I am starting with operating profit of 650, which is technically profit before interest and tax or profit before tax. So even if I say this 650 is profit before tax, it is the same thing as saying this profit before what? Interest and what? And tax. So let me start from 650 and let's solve it. This is quite very simple. This should be kindergarten. I don't know why they're giving this kind of question. Okay, let's see. The operating profit, look at the question. No? The operating profit, which is this operating profit here, included $5 million expenditure for research and development costs, which have not been capitalized. Okay, in accordance with financial reporting standard, calculate beta snowpart for the year ended 31st December 20X1. Let me read it again. Let us be clear. The operating profit included $5 million expenditure for research and development costs, which have not been capitalized. In accordance with financial reporting standards, calculate beta snowpart for the year ended 31st December 20X1. Let me see if I have that solution here. Okay, I have that solution here. Good. Now, looking at this question, who can tell me one striking thing that I've said? Who can tell me one striking thing? Or who can tell me the thing that I should be aware of in this question? Who can tell me? Please, if you know your background is not noisy, I will really appreciate. What should I be aware of in this question? Just do a summary for me. What should I be aware of in this question? I've mentioned I should be aware of the profit figures, Abi. Who can tell me what I should be aware of again? Who can tell me? I can't hear you. Who is that?
Okay.
Please mute.
Hello, sir.
Yes, speak, please. Thank you.
Okay, we should be aware of our research and development cost, which we are going to add it back in our POA and let it back in our net asset.
Okay. Thank you very much. So he said that we should be aware of our research and development costs because we are going to add it back to our P&L, and then he said we're going to add it back to net asset. Are we not amortizing it?
Yes, we are going to amortize it in our balance sheet.
Okay.
As 5 million, since they didn't give us the number.
I can hear you. Please go ahead. Thank you. I can hear that. Please.
I said the number of years for R&D is not stated. It's not given for the amortization.
Yes, we are going to amortize the whole 5 million naira since they didn't give us the amount of years in the question.
Thank you. So what I wanted you to point out for me is that the number of years was not given to us in this question for the R&D, research and development. Therefore, there will be, we cannot amortize, we cannot say divided by so. I guess now we cannot amortize, now we only add back. Does that make sense now? Let's see what we can. Okay, can anybody tell me any other thing that you can see again apart from that? Can you tell me any other thing that you can see again? If your biro and your book is not far from me, please hold it because I want to be stating one important rule I said I want to tell you. Can you see any other thing again?
Interest expense.
Interest expense. Powerful. Powerful. Am I making sense now? Interest expense. But the problem is, what do we do to interest expense? What do we do to it?
You get the tax percent on it, which you remove, if I'm correct.
Excellent. If you are correct or not. Please mute. Thank you. Thank you very much. Thank you. Now, this is the rule. Write it down. Write it down. Rule 1. I'm going to give you 2 powerful rules. Rule 1. When you are computing your NOPAT, starting with operating profit before interest and tax. I hope you are writing now. When you are computing NOPAT, starting with operating profit before interest and tax, you must deduct tax plus the tax element in the interest. Oh, don't get it. When you are starting with, when you're computing NOPAT in EVA, starting with operating profit before interest and tax, you will deduct the full tax because you have not deducted tax before, and the interest portion, the tax portion of the interest. I've rested my case. I'll give you the rule number 2 when we start solving the next question. Let's go ahead and solve this question.
Please, you said, sorry for taking you back. You said rule number 1, if we are computing the no part ever before, I didn't get the what you said before this thing. Network was breaking.
Are you in Lagos?
Am I in Red Cross?
Lagos. Are you in Lagos
Yeah.
or outside Lagos?
Yes, I'm in Lagos. I just came back.
Okay. Now, when you are, let me go back to that. When you are computing NOPAT, I get to that is net operating profit after tax, starting with operating profit before interest and tax. When you are computing NOPAT, starting with operating profit before interest and tax. I get it now. Deduct your tax and the tax portion in your interest expense. Deduct your tax and the tax portion of your interest expense.
I've gotten it. Thank you.
You're welcome. Now let's after that. I'm not solving. You guys should solve for me. Okay, ladies and gentlemen, let's do that. So this is where you focus on now. Betta's company. So computation of NOPAT. So I said, let's start from, we are starting from this 650. Isn't it? So that's how we have this 650 that is the operating profit. Now, what did I say you will now look at? You are going to look for every other figure that is going to affect your operating profit, Abi. And in this case, please forget about anything down here. Let me mention that rule. Forget about, if you are starting with operating profit, forget about anything below operating profit, except interest and tax. Please add that to your rule. If you are starting with operating profit and you are giving a profit and loss account like what you can see on my screen, forget about anything below operating profit, except interest and tax. Are we good? So in this case, 650, what concerns me is everything above 650. But physically, you cannot see anything above 650. But the question gave to us that the operating profit included 5 million expenditure for R&D, which have been capitalized, which have not been capitalized. That means there's a 50 what? There's a 5 million up here that you cannot see. that was deducted before they got this operating profit. Does that make sense now? So forget about anything after the operating profit if you are starting with operating profit, except interest and tax. Focus on the thing before the operating profit. And those things will be given to you most times in the notes, just like this 5 million expenditure for R&D has been given to us. What are we going to do? Add it back. So that's what I did here. Add back R&D. Now, normally I'm supposed to divide the R&D by number of years, but they did not give me information. They cannot deceive me. I left it alone. Am I making sense now? I left it alone. So that is, I can go and stop there. Then there's nothing again. There's no any other expenditure again that was given to me as my notes before the operating profit. The other thing I will now focus my mind on is my interest expense and my taxes. These are the other two things that I want to pick. Very important. Interest expense and my taxes. For my tax, I will take 100% of the tax, which is 140. Okay? 100% of the tax, which is what? 140. For the interest expense, I will only take the tax inside the interest. I will only take the tax inside the interest. So run the tax for me, 25% of 90 per. What does that give us? 25% of 90,000. What does that give to us? You got me. 25% of.
Okay, that's 22.5.
5.
Sir, 20 what, sir?
25.
God bless both of you. Both of you will go far in your career. As you are making this work easier for me, you will go far. So 140 is given to us. That's the 140 is our full tax. Then the 25% of 90 is my 22.5. I only decided to do this as a working. You can put it on the body of the solution. It does not matter. You can say add tax, subtract tax 140 and subtract what? Tax relief on interest 2.5. So I just did the solution like a working year. Say 140 to 2.5. I took the final figure 162.5 and I subtracted it. I get it now, and I subtracted and I got my no part. So please, that rule is very important when you are starting with profit before interest and tax. And so that at all, when you are done with your solution, you must deduct your full tax and the tax on interest alone. Those are the two things that you need to deduct. Most students usually go and add usually go and deduct the full 90. Now the full 90 for interest. Because Abi is an expense now. Let me go and deduct it. No, it is only the tax portion that you need. I get it now. Don't forget that interest is not taxable. If you have done taxation, you should be the one teaching me this thing, not me teaching you. Let's take another question. Please, is this one clear? Is this one clear? Is it clear? Are we on the same page? Okay. Are we on the same page? They did not tell us to compute EVA in this question. We are only told to compute what? No parts. That's what they told us to compute in this question. Is it clear? Is it clear?
Yes, clear. Yes.
All right, let's move to another question. Zico. Zico. Let's take it out of that question. Okay. Please mute from your end, though. Thank you. Yes, I have. Is this done? Yes. Please, let's read this together. Let's see what we have here. Now, look at this. B division of Zico has operating profit and asset as below. They give us gross profit in this question. Normally. I don't need gross profit. So if you see gross profit, that should not be an option for you. Just go to your net profit. Go to net profit. So after gross profit, we have less non-cash expenditure, $8. That's 8,000. Then we have amortized goodwill. This is detailed. Then interest was deducted as well. They now got profit before tax. Profit was before tax. They did not deducted tax. They now got profit what after tax, which they call net profit. So in this particular question, I will not be starting with profit before tax. I'll be starting with profit after tax, which I said is still the same as profit after tax and interest. So I'll be starting from 90, as well. I'm starting from 90,000. Okay. So they now told us that total equity is 350. Pay attention, no. Total equity is 350. Long-term debt is 150. Then we have 500,000. Then I said that Zico has a target capital structure of 25% debt and 25% equity. The cost of equity is estimated at what? 15%. What about cost of debt? They didn't tell us cost of debt. Please, your cost of debt is your interest. In case they did not tell you, in as much as they put interest here, this is your cost of debt, 10%. They don't need to tell you again. Okay? So let's go back and read again. Zico has a target capital structure of 25% debt and 75% equity. What does this mean? I told you that when you are solving for your EVA, you need your NOPAT, you need your returns to equity, returns to debt, and you need your net asset. So that return to equity debt, that's what we call weighted average cost of capital. And I mentioned that you can be giving your weighted average cost of capital free, Sarah. ICAN will not stress you. Just like the first question that we solved, they gave us the weighted average cost of capital of 12%. But you see, in this particular question, I can say lie. Okay? On the assumption that you know how to compute it. Next rule. This is the rule that will guide you to compute your weighted average cost of capital. When you are computing your weighted average cost of capital, you need 4 things. You need 4 things. Anywhere in the world at this level, you need 4 things. You need your value of equity. You can jot it down. You need your value of equity. You need your value of debt. So you can put it as 1. Value of equity and value of debt as 1. Then you need your cost of equity and your cost of debt as 1. If you get these 4 things, trust me, you are gone. Okay? Am I making sense? Am I communicating? Okay.
Yes.
So you need your value of equity and value of debt. You need your cost of equity and your cost of what? Debt. Does that make sense now? Now, that is why the now says Zico has a target capital structure. Whenever I hear the word capital structure, that is your value.
Yeah, me like him ass.
You're on your own. When I log you out. When you hear the word capital structure, just know that is the value. Okay, that is value. To look at it as Zico has a target capital structure of 25% of debt. And this will say the value of debt is 25%. Then the next says 75% equity. That means the value of equity is 75%. That what it simply means is that all the money that the company has, 25% was sourced from debt and 75% was sourced from equity holders. That's what it means in reality. So that's what we mean by value. All the money that this company have, if you know all the money is 100%, 25% of the money is coming from where? From debt, and 75% is coming from where? Equity. So therefore, when you hear the word capital structure, bear it in your mind. I said so. 25% of this money in this capital structure is what? Value of debt. 75% is value of equity. Okay, good. Then the next said that the cost of the equity is estimated to be 15%. They gave you cost of equity here, so we have seen cost of equity, but they never said anything about cost of debt. You do not need to panic. Go back to your P&L account given to you. The amount you are paying as interest is the cost of the debt. So when they say interest at 10%, that means the cost of your debt is the interest you pay to them, which is 10%. Use that. So the 4 things that I say you are actually complete in this question, we are good to go. Let's go further. The capital employed, aka net asset, at the start of the period amounted to $450,000. So your net asset as at the beginning of the year is 450. Then the division had a non-capitalized lease of 20,000 throughout the period. Then the next said that goodwill previously written off against reserve in acquisition in previous years amounted to what? $40,000. Look at the question is strong, it's detailed. So the requirement is that we should calculate our EVA from this question. Calculate your economic value added. Very simple. Let's see if I have my solution here. Okay, that's it, Zico. Now, don't forget, I told you that the first thing that you need to do is to compute for your NOPAT. And you can decide to start from profit after tax or profit before tax. In this case, we started with PAT, profit after tax, which is 90. Isn't it? Now come back to the question. Because you are starting from 90, it means that everything above this thing concerns you. Remember the now. When you are starting from net profit, which is 90, everything up is your business. Go and begin to look at everything up and pick the one that relates to your adjustment. The same way when I was taking this particular question, I told you that because we started from 560, we started from 650 here. Everything on top of 650 is our business. The only thing that becomes our business under it is interest and tax. The same thing applies here. If I'm starting from 90, everything above is my business because everything above has been adjusted for before we got our 90. So let's start from everything above. Forget about gross profit. Leave it alone. If you don't look for your trouble, leave it alone. Start from the expenses part, this non-cash expenses. So we have a non-cash expenses of $8 there, or $8,000 anyways. So since it is non-cash, who can tell me what we are going to do? Let's solve it together. Oh yeah. Since it is non-cash, who can tell me what we are going to do?
I'm going to add back.
Oh, Jesus. Oh. Let's just add it back. How much? Look at it. 8 million. 8 million. Yeah, let's go. Where's the question? Next one. Amortized goodwill. Amortized goodwill. Please, is goodwill a cash or non-cash item?
Non-cash.
Non-cash.
Oh, yeah, thank you. So what are we doing?
We are adding.
It's, look at it here. But let's go to the next one. What's the next one? Interest, Abby?
Yes.
Good. Now, because we are starting with profit after tax, this is the way you will treat it. When you start with profit after tax, rule number 2 from that first rule, you are not going to touch tax at all. But you will need, are you getting it now? You will need the non-interest portion of the interest amount. Oh, Jesus, you don't get it. When you are starting with profit after tax, forget about tax because they have already deducted tax. So you don't need to go and be deducting tax again. Leave tax alone. What concerns you is the interest. And this interest now is divided into two. We have inside this interest, we have the tax portion and the non-tax portion. The first one that we did, we focused on the tax portion of it. That we said do 25%, the tax portion of the interest. This time we are looking at the non-tax portion. So if our tax is 30%, that is to say the non-tax portion is what? 70%. So you're going to do 70% of this 15,000. This 15 that we have here. Please, am I making sense? 70%.
Explain again.
What did you say? Sorry, I didn't get you.
Please explain that part of 70%, 30% again.
Thank you. It means that you are following. Now, let me explain it again. This interest is 15. Inside this 15 now, tax is there and the part that did not tax. Just take it that way. Now, what we want to do now is that we are only concerned with the 70% of this 15, not the whole 100% of the 15. Why? Because 30% is our tax. 100 minus 30 is 70%. Okay, 70%. That 70%, we call it the non-tax portion of our interest. I guess it's the non-tax portion of our interest. That is what we are concerned about. Okay, so we're going to say 70% of this 15. That is what we need. Okay, we do not need the 30% of the 15. When you do 30% of 15, what you're getting is the tax portion, the tax in the 15. But when you do 70% of the 15, you're getting the non-tax portion of that 15. So if you do 70% of 15, what do you have?
10.5.
Ah, wait now. Help us. This thing is going to be recorded and shared. Ah. So run it for me, please. Somebody was telling me a figure, Jerry.
Yeah, that's 10.5.
That's 10.5. Now, still pay attention. Do 10.5 minus 15. What do you have? $10.5 minus 15. What do you have?
On that give us minus 4.5.
4.5.
Thank you. That 4.5 is the tax inside of it. There's something I want to tell you, but I'm trying to understand. I'm trying to see whether you have an idea of it. Do you know that any expenditure that you put in your profit and loss account? Okay, let me put it this way. Please pay attention as much as possible. I want to give you an high-level idea here now. See this tax that you see here, that of 30% that we put here. You know, we did 30% of 128,000. We did 30% of 128,000 for us to get 38. It is the same thing as doing 30% of 8, 30% of 5, 30% of what? 15, 30% of 156. Do you agree with me? Then we will not deduct all these 30% here from the 30% of this one. Do you agree with me? I'll give you 1 minute. All the income and expenditures that you see in your profit and loss account, that if you calculate finish, you will now say tax of 30%. If I don't want to do 30% on the final answer, I can do 30% of all the individual figures. Do you agree with me? Wahala, who sent me message? Who sent me 20? So say, hey, Jesus. Okay, let's do this. Let us do this one together. Let's do this one. Let's say 100, Abi. Please, let's do this one together first. 100 minus, don't mind my pen, no, minus 30. What do you have, please? You have 70, Abi. Please
70.
run 30% of 70 for me. Run 30% of 70 for me.
Oh, that's 21. 21.
21. Oh, yeah, minus it from that 70.
70. That's 49.
49, Abi. Are you sure?
Yes.
Yes, sir. Correct.
Okay, thank you. Please, that person should mute. I beg you. I beg you. Please help me. I don't like noise. Now, let us assume that this 100 is revenue, okay, for the company. Okay, let's assume that. All right. Then this 30 is cost. Okay, that's the cost that your company incurred. Do you understand? Then this 70 is what? Net profit, Abi. You understand, Abi? Net profit. Net profit. Don't mind me, this thing. Then this 21, we'll call it tax, Abi now. Okay. This one is not net profit. Let's call this one tax. Let's call this one tax. Please just stay with me small. I just want to show you something. Okay. That 70 is let's call it gross profit, Abi. Where's this thing? Okay. So let's just say GP. Let's just call it GP or profit before tax, anyone. Okay, now please just flow with me. Let me just explain one simple thing for you so you understand what I'm trying to say. Please do 25%, do 30% of 100. What do you have?
I have 30.
Oh, yeah, do 30% of 30. What do you have?
That's 9.
That's 9. 30 minus 9.
30 minus
21.
1.
Is it not the same thing with your tax year of 21? Is it not the same thing with this tax year of 21?
Yes.
Do you understand where I'm coming from now?
Yes.
This is, I don't know whether you did financial analysis, or this is part of the analysis that we're talking about. So that this tax that you are saying, 30% of 128 is equals to 38. We can actually calculate that tax without relying on that 128. We'll just go and do tax on all income. On all our expenditure, we'll just minus it. We'll still get the same tax. That's what I'm trying to explain here. So every figures you see in your P&L account has two figures inside. It has tax element and non-tax element. That is why in this interest, what we are only concerned in this 15 is the non-tax element. Am I communicating now? So inside this 100, which is revenue, the tax element is 30. The non-tax element is 70. Under this 30, which is costs, the tax element is 9. The non-tax element is what? 21. Abi? That is it now. Do you understand what I'm trying to say now? So please, this is the rule. You can watch this video over and over again to understand. Are you getting it now? But just know that whenever you are starting with profit after tax, the interest that you are going to adjust for, pick the non-tax part of that interest. That part is not taxable. Okay? That's the part you are going to pick. That's the rule. If you can cram it, cram it. If you can understand it, that is best for you. Do you understand? All right. So that's what we are done. So please, if you add everything up, you get your NOPA. Your NOPA. Your NOPA is 113.5. Are we making sense now? Good. Now let's move to the next. Please, is it clear? Is it clear? You respond. Praise, are you with me? Is it clear?
Yes, sir.
Good. If it's clear to you, it's clear to everybody. Oh yeah. Let's move to step 2, which is net assets. Yeah, although I call it a working capital adjustment anyways. You can call it capital employed adjustment or net asset adjustment. Now, in this, our net asset, look at the question that they gave to us in our net asset. They gave us opening figure of net assets. Let's go and check. So they told us that our capital employed at the start of the period amounted to 450. Please use the one at the start. Yes, thank you. Use the one at the start. That's what, because you want to adjust. So you want to adjust. In case they give you start and close, use the one from the start to get the what? The close. Are you getting it now? Because this is the close. Look at the close here. Look at it. 350, 150. But then I gave you stats. 450. Some students will go and use 500. They have go. Use 450 from the start because we want to adjust to get the real close. So 450 is what we're making use of. So that's how we have capital employed at the beginning, which is at the start, 450. Are you getting it now? What did I tell you about lease? I told you that lease should be added, Abby. So they gave us lease and goodwill. So those ones should be added back. Let's go and check. There's a place they told us for lease. Okay, yeah. The division had a non-capitalized lease of 20,000. So go and add it back because it's non-capitalized. We've not taken it to the balance sheet. Then there's another goodwill previously written off against reserve in acquisition in previous settlement. Why are you writing off goodwill? Was it a cash item before? It was never a cash item. Why are you writing it off? My friend, go and add it back. Okay? Go and add it back. I don't know what's wrong with them. So let's go and add those guys back. So non-capitalized lease added back, 20,000. Goodwill, I don't know who sent them. Go and add it back, 40,000. So I don't think there's any other thing there again. So if you look at the way we are calculating this our capital employed now, there's nothing like a replacement amount. You see it. So you have to solve several questions for you to be guided. So you know that first one also is something like replacement amount of a non-current asset, net non-current asset. So if you are not smart enough, you will not be able to calculate this on net assets. But once you know the formula for net asset, anyhow they want to give you the figures, know that that is how you are going to what? The game you are going to play for them. So they give us opening net assets. So what we're going to adjust it to get our closing net assets. That means this 510 is our closing net what asset, which is what we need. Then the last part, which I want you to focus your eye and your brain with me now, is how to calculate the WACC, how to compute the WACC. I told you that you need 4 things to compute your WACC. You need your value of equity and value of debt, your cost of debt. Now look at this question now. Equity, I dealt with equity first, and before I dealt with debt, and I marry both of them with a plus sign. Okay, I married both of them with a plus sign. So work with me. For equity, I said value of equity times what? The cost of equity. They look alike, Abi. Then for debt, I said value of debt times cost of debt. Oh, Jesus. Now listen, value of debt times cost of debt post-tax. Write it like that. Value of debt times cost of debt post-tax, meaning after tax. Good. Let's go. Let's go to the question. Please, what's the value of equity? Who can tell me? What's the value of equity? Sharp, 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 sharp. It's on the screen now.
Huh? 25% equity.
Praise.
Sir?
What's the value of equity on my screen?
75.
Thank you.
25% equity.
Like you are not seeing it. I told you whenever you hear the word capital structure, that's value. I mentioned that and I stressed it. My saliva dried. Capital structure, 25% is debt. That's the value of debt. 25% is equity. That's value of equity. So what's the value of equity? What's the value of equity?
25%.
So what's the value of, what's the
75%.
Thank you. What's the cost of equity?
15%.
God bless you. As you are answering, you will never forget it. So that's why we put there 75% times what? 15%. Am I making sense now? That gave us 1125. You get to punch it, because if people did not punch it, you would think that you understood what is there. There are 2 percentages there. So please punch it. Let us be sure. Punch it. Because you think that you understand until you enter the exam. Or do 75 times 15. What do you have? Hey. 75 times 15, what do you get, please?
1,125
Divided by 100.
divided by 100. So that's 11.25.
That's how we got that 11.25. I have seen a student that said divided by 100, and she divided it again by 100. So I have the reason why I'm telling you to punch, because she saw 2 percentages there. She said, that means I'm going to divide by 100 2 times. I was morose and dejected. So please, divide by 100 once. Please, let's go to the debts. Who can tell me the value of debt? Value of debt.
Our interest, 25%.
You're on your own. You are on your own. You're on your own. It's not me that taught you. Value of debt.
25%.
Thank you. Then what is the cost of debt?
Cost of debt. 10%.
10%. Then how can you convert this 10% to post-tax? Don't worry. You may not be able to get it. Just let's come back. So 25% value of debt, Abi. 10% yes are what? Cost of debt. Post-tax, that means after tax. Remember that your tax is 30, Abi. And normal percentage is 100, Abi. So 100 minus 30 is equals to what? It's equals to 70. Don't mind my this thing. No. Right. So that's how we have this 70% here. Please, in some textbooks, this is the way they are going to do. They are going to tell you, or in some ICAN, this will tell you 10% before you will say, this is not what this man taught us. So 10%. Look, they will not say times. Are you seeing it now? You know, the question is 30%. Abi? 30 divided by 100 is what? 7.3. So they will not say times into bracket. Are you seeing it now? 1, listen to me, minus 0.3. Okay, they will now close it. This is the way they usually solve it. So 1 minus 0.3 is 0.7. 0.7 is still the same thing as what? 70%. Are you seeing it now? So anyhow you see it in this, it's the same thing. So 0.7 times 10. Oh yeah, run it for me. Can somebody do this math for me? This one here. 25% into bracket 10% times 70%. Let me see if you get 1.75. Can somebody run it for me? Board maths. Board maths.
Okay. Okay, 10 times 70 give me 700. Oh, by 400. That's 7. 25. That's 125. Divided by 100.
Do you get it? That's 1.75, right? It's not there again. That's 1.75, right?
Yes, sir.
Uh-huh. Please, if you get it, that's good. That's good. So solve for the bracket first before you now solve for this guy outside. So if you now add both together, you now get 13. That 13% is our weighted average cost of capital. So my ladies and gentlemen, we are done. We have gotten no parts. We have gotten our net asset that we're going to use, which is 510. They've gotten our weighted average cost of capital, which is 13%. So the last thing I just need to do is to plug it into the into the EVA formula. So step 4, compute forwards for EVA. No part is 113.5, which has been given to us, which we have done here, sorry. Then our net asset is 510, which we have done here. Then our 13% is our weighted average cost of capital, which is 13% here. If you do this mathematics, 510 times 13%, you get 66.3. Take it out from this 113.5, you get $47.2. Please, who can interpret this $47.2 for me? In case the question says C, interpret your answer in B above. Who can interpret for me? Praise. She has gone.
Yes, sir.
Yeah. Interpret. 47.2, interpret. So let's know what we are doing. Folake, can you help us? Who is Folake? Or Miriam B. I don't know if you are still in traffic. 47.2. It is EVA now. Who can interpret the last answer? I interpreted the former ones. Oluwatosin, please help us.
I don't know. I think he said no part is value has been added or something.
Hello?
Hello?
Yes,
Hello?
we can hear you. I can hear you.
Hello, sir.
Yes, I can hear you now. Thank you.
Yeah, no part is greater than it means that maybe value has been added or something.
It's simple. The value has been added equal to 47.2. Value has been added. Thank you very much. In that same question, we are told to calculate residual income. Okay, in that same question, we are told to calculate residual income. So I said, note, same question to compute for residual income. You know, the formula for residual income is net profit minus interest charge. Isn't it? Good. And our net profit is 90. We don't need to adjust. Whenever you're computing your residual income, you don't need to go and adjust again. You know, you don't need to go and adjust your profit. Use the profit that is given to you in the question. So in this question, the profit given to us is 90, which is our net profit. It is only for the purpose of EVA. It is only for the purpose of EVA that we are readjusting our net profit to become no part. But for the purpose of residual income, please do not readjust. This question is tested in ICAN, and I'm telling you authoritatively, do not readjust your profit. 30%, I get it means our WACC. Use that WACC that are computed like that. Then your interest charge. This interest simply means your interest on net assets. For those of you that have done imputed residual income with me before, your residual income formula is net profit minus interest charge. where your interest starts is the interest times the net asset. Please do not use the 510 that you got from your adjustment of net asset. I get it now. Use the one given to you in the question directly, which is your closing 500. This is it here, 500. Use that one direct. That is your closing. Remember, we were giving closing of 500 and an opening of 450. For no part, I told you to start from 450 and adjust to get your own closing, which is quite different from their own closing. But for ROI, use their closing like that. There's nothing for you to adjust. So that's it. Then if you multiply, 30% of 500 will give you 65. 65 minus 90 will give you what? 25,000. So according to ROI, your residual income, that is to say your profit after you have paid those that gave you capital, will be 25,000. That adjustment, $25,000. Are you getting now? $25,000. So that is the end with these questions. All right, that's the end with this question. There's a question that is tested in May. Was it in May? Oh no, yeah. That was tested in May 2020, question 3. That's whose or chooks. This is the question. This is the question. Whose or chooks. This is the question. Okay. 20 marks. 20 marks. And we are told to compute and evaluate the company's performance using average return. I will not do that. I would only do this 9 marks, okay, which is EVA. Compute and evaluate the company's performance using economic value added parameter, which is 9 marks. But before I go to that, please, I will entertain a question, any question for just 1 minute. Just 1 minute. Any questions so far? For those of you who have stayed with me till now, any questions so far? Any questions so far? I only need 15 minutes to solve that question. Any questions so far? So if you don't have questions, please just let me know that it's clear, then we can proceed. Praise. Okay, so everybody is clear, Abby? All right, thank you for your silence. All right, Uzo Chooks Nigeria Limited is a company established 4 years ago to produce medical equipment. The income statement and statement of financial position for 2019 and 2020 are as follows. Income statement, we are for 2019 and we are for 2020. We are giving the sales, operating profit, that gave us profit, operating cost, that gave us operating profit. Then finance cost, which is your interest, that gives us profit before tax. Then we have our tax, and that gives us profit after tax. So we can decide to start from operating profits, okay? Then we can start to even start with this guy, or we can start to start with this guy, anyone. So we'll follow what ICAN did. We have time. Then let's go down. We're also giving balance sheets. So it's a statement of financial position. In particular, we have non-current asset was given to us, current asset, total assets. Shareholders fund, we have long-term and medium-term debts, 100, current liability 40, then total. So 450, 540, 700, 540, 700. That's our net assets, okay? It must always be equal. Our net asset is, our net asset is this guy, total assets less current liability. That's our net asset. I'm already telling you expo already. Why? Okay. Other information are given below. That's where the cocoa is. Then I said that operating costs include the following. So this operating cost you are seeing up here, which is this 180 and 200. What is inside our operating cost? That's the breakdown they are giving to us now. What is inside there? We have depreciation, we have provision for doubtful debt, we have research and development, we have other non-cash items. We already know how to treat all these things, so they cannot deceive us. Makes sense, Abby? Thank you. Let's come down. Look at this one. Then I said, economic depreciation is assessed to be 50.5 million in 2020. Economic depreciation include any appropriate amortization adjustments in previous years. It can be assumed that economic and accounting depreciation were what? Were the same. So they told us that in 2020, that there's an economic depreciation of 50.5. But that this thing that we are solving is for 2020 because we have 2 years, 2019 and 2020. But what we are solving for is for 2020. You don't need to be told. Okay, you don't need to be told. You are solving for 2020, which is the current year. They are only giving you base year to do 1 or 2 adjustments. All right. So let's look at that. Let's look at that. So this 50.5 we present our economic depreciation. Your economic depreciation. Does that make sense? Then we have tax. We say tax is the cash paid in current year. Okay, 16 million and an adjustment of 2 million for deferred tax provision. When you hear the word deferred tax in any EVA question, why add it back? Nothing concerns us and deferred tax. Deferred tax is for next years, not the current year. So we're only calculating something for current year. So if your tax figure comprise of current tax and deferred tax, please take out your deferred tax. We're going to look into it as we proceed. Then provision for doubtful debt was 2.5 million in 2020 statement of financial position. We're going to analyze that. Then research and development is not capitalized in the account. It relates to a new project that will be developed over 5 years. So they gave us 5 years. And it's expected to be of long-term benefit to the company. Good. 2020 is the first year of this project. Excellent. We know what to do with this one. Chicken. The company had a non-capitalized lease asset of 18 million in January 2020. Just go and add it to your net assets. Very simple. Then look at here. They say cost of capital of Us or Chooks. Cost of capital. Cost of capital. So these ones are given to us for us to calculate our WACC. So this is capital structure. What did I tell you about capital structure? That's value of capital. Then this one is cost of capital. So we need our cost of capital to compute our WACC. So the IX does not actually belong to EVA. I'm going to tell you why. We're going to come to that as we proceed. Now let's use this question to let's play with this question and solve it. Do I have the solution? Yes, this is it. Okay, forget about these ones. There's nothing here. All these ones here. There's nothing there. So focus your mind here. So we have Us or Chooks. Okay, Us or Chooks, May 2022, question 3. Now the formula for EVA, that's the first thing you need to invoke. Okay, formula for EVA, we state that no part minus capital charge. So let's solve for no part first. Okay, so we started with profit after tax. We started with profit after tax, which is 48.8. Let's go and check that question. Profit after tax, okay, good, which is 48. Sure, let's see, let's confirm that. Okay, 48.0, yeah. So we started with profit after tax, which is 48. So that means everything above concerns us, isn't it? Everything above concerns us, isn't it? Good. So let's begin to treat everything above. They didn't tell us anything about sales, so forget about sales. But they told us something about operating costs. So that operating cost is what we are the operating cost. In the operating cost, we are told clearly that depreciation is 28 million for 2020. What do you do? Add it back. So this is what I did here. So I said add, I said it, depreciation 28.0. Am I making sense now? Add depreciation 28.0. So I want to tick in this thing. Thank you. So let's do it again. Let's go. So let me 28 million. Then let's go back. Let's go back. Okay, let's go back now. So what's the next thing in the question? Apart from depreciation, we also have provision for doubtful debts. I told you that provision for back. They go only 1.2 million. So let's go add it back. Provision for doubtful debt, 1.2 million. This thing is not hard. Let's go again. We have research and development, but they did not put any figure here. Abi? But what did I do? I have my research and development 5 million divided by 5 million. It simply means that they did not treat anything related to research and development before. I guess now they did not treat anything related to research and development before. If they had treated, I would have added that figure back before I now amortize. But now they did not treat anything related to research and development before, so just amortize directly. Do you understand? Normally there was 5 million here under research and development. I would have come to my solution and said, add research and development 5 million. Then I will now say, less, I get it now, the portion that relate to this year. But in this case, nothing was treated for research and development portion that belongs to this year. So how do I know the portion that belongs to this year? The question gave us an hint, a simple hint. It told us that research and development is not capitalized in the account. Yeah, that's why they did not add it here. Good. So it relates to a new project that will be developed over 5 years. That's 5 years. And is expected to be of long-term benefit in the company. 2020 is the first year of the project. So we're starting the project from 2020. So what? 2020. So what's our figure for research and development? This figure that you see in 2019, which is the closing figure, will become the opening figure for research and development in 2020. So that's how in our solution, what I did was to say $5 million, $1 million naira divided by 5 years. That gave me 1 million. Yeah. I hope I'm communicating. Go back to the question. The next thing that we have is other non-cash items, which is 3 million. All right. So go and add it back. Other non-cash item, 3 million. Are you getting it now? So go back to the question. We are done with everything here in this thing. Let's go up and see. We are done with everything that concerns operating costs. Operating profit, there's nothing for us to do there, okay? But we have something to do with finance charge, but we'll come back to it. Profit before tax, there's nothing for us to do there. Tax, there's nothing for us to do there because we are starting with profit after tax, so they've already deducted tax, so there's nothing concerns us with tax again. So the only thing that catches our attention here is our finance cost, which we are going to come to. Okay, so let's go and check additional information if there's any other thing that we can adjust for. Depreciation, we've done the depreciation, Abby. We've done depreciation. Yes, 28.8. But they told us now again that depreciation is assessed to be 50.5 million in 2020. That's economic depreciation. So now that we have added back about 28 million, which is the accounting depreciation, which is this guy, okay, we have to go and add back we have to go and deduct the real depreciation, which is the economic what? Depreciation. That's how we got this 50.5. The next one is that they told us that tax is paid in the current year. I don't have any issue with you paying tax. Okay, that's why I don't have any issue with you paying tax. But bro, this is 60 million for the actual tax and 2 million for deferred tax. That gives us a total tax of 18 million in 2020. Let's go and check our financials. How many million did we subtract in our financials? We subtracted 18 million. Let me show you. Where's my eraser? Okay. Now, we subtracted a whopping 18 million for tax. Now, they now told us that the breakdown of this tax is that 16 million is for this year. 2 million naira is for deferred. Nothing concerned with deferred. We're talking about this year. So what concerns us is 16 million for this year. So let us take out that 2 million. Okay? We're going to take out that 2 million that they told us that is deferred. Look at it here. Tax is cash paid in the current year. So we paid cash taxes. Okay? And that tax that we paid, 16 million belongs to this year. And 2 million belongs to next year. So let's take out that 2 million that belongs to next year. When we get to next year, if we're doing EVA, we'll calculate that one. Okay, so let's take that out. So that's how we got this deferred tax. Please, I hope I'm communicating. I hope we're on the same page. That's the key. Oh. That's the key. Then the next one, let's see the question. Is there any other thing there? The provision, where are you? The provision for doubtful debt was 2.5 million on 2020 statement of financial position. We've done provision before. Let's check. Yeah, we've done provision of 1.2 million, but they are telling us another provision. They said the provision for doubtful debt was 2.5 on the statement of financial position. And our first statement of financial position, we'll take it to net asset adjustments. Makes sense, Abi? Then this research and development, we have done it before. Then the company had a non-capitalized lease. Non-capitalized lease is net asset. So take that to net asset. Is there any other thing? Oh, very simple. They are done. So let us go and pick that interest. Let's go and pick that interest. Where's the interest guy? Starting with profit after tax. How do we calculate this interest? What do we need from the interest, please? Who can tell me? What do we need from this interest? Now that we're profit after tax, who can tell me what we need from this interest?
Okay, we need 20% times 14.
5% times 14, ba? Oh, this man.
20% times 14.
75 or 25?
Nice.
Huh? Yeah, Soros. Is this 75 or
Yes, that's the non-tax element.
Good. That is 75%, ba.
Non-tax element is 75%.
Thank you. That's what we did here. You see it now. So we did 1 minus 0.25. If you do 1 minus 0.25, you get 0.75, which is 75% of 14. That's how we got this figure. There's nothing, don't bring tax into this thing again. There's nothing like tax because we started with profit after tax. That is all that we need to do. So if you do your mathematics from beginning to end, you get 41.2 million. That's our no part. You understand? So now let's go and adjust for our working capital. Okay, that's our net assets we're talking about now. So we need to start with our opening capital employed. I always tell you that, okay? If you have, it depends on how the question comes, but start with your opening capital employed, then you can now adjust, all right? You can now adjust for it. Now let's go to the question. Please, you can mute. I think it's speaking noise from here. Tracy. So who can tell me how I can get my opening capital employed? Who can help me? So I will be looking at my balance sheet for that, right? Anything capital employed, I'll be looking at this guy here, isn't it? So who can tell me how I can get my capital employed? I've already told you free of charge that your total asset less current liabilities, your capital employed. But how do we get our opening capital employed? Who can tell me?
Yeah, I think we can check our share information if there's anything regarding that.
Okay. For opening capital employed, right? I don't think so. I think we read it together. I didn't actually see anything relating to opening capital employed. I didn't actually see anything relating to that. So if I don't see, what do I do? Tracy? Oh yeah, help us. Or is she just joining? What do I do? Praise?
Okay, I think in that case, maybe I can assume.
What are you assuming? What are your assumptions? Is Tolu here? What are your assumptions? Coca students, are they here? Beautiful. You have 2019, you have 2020. The closing of 2019 becomes the opening for 2020. Do 540, Jare, minus 40. What do you have? 540 minus 40, what do you have?
0.
500. Thank you. And now, 540 is your total asset for 2019. Current liability is 40. I was asking Coca students to tell me the definition of a net asset. They are telling me that it's total asset minus total liability. If they apply that formula here, they will get a wrong figure for net asset. So I hope that they are here and they can hear me. That net asset is total asset less current liability. So 540 minus 40 will give you 500, which is your net asset as of 2019, which will resume with you, okay, into 2020. Makes sense, right? So that's why we're having 540 minus 40 to give us 500. Does that make sense? And that's our opening capital employed. Then every other thing, non-capitalized lease, non-cash item. I told you before that whenever you hear the word non-cash item, as you are adding it back to your profit, please come and add it back to your capital employed. That's what you have here. I also told you the same thing for your lease. Your lease that is not capitalized, please bring it here. Add your lease, non-capitalized lease. Then the last part is provision. The last part is provision. Look at the provision that they gave to us here. I told you I was going to be looking at your balance sheet for it. This is it here. The provision for doubtful debt was 2.5 million on the 2020 statement of financial position. 2020 statement of financial position, your provision for doubtful debt is 2.5 million. If your provision for doubtful debt is 2.5 million, and you have expensed 1.2 million. Look at it here. You have expensed 1.2 million to your P&L account that same year. That means that what is in your provision for doubtful debt now in your balance sheet is 1.3 million. Do you agree with me? So that's what I did here. So provision for doubtful debt, 2.5 million was in your balance sheet initially. Okay. So when you prepare your P&L, you took out 1.2 million. All right. So when you took out 1.2 million, what will be left? 1.3 million as your what? Provision for what? Doubtful debt. Does that make sense now? That is all. The only thing that is not appearing in this our working capital adjustment is this R&D. Are you getting it now? Why is R&D not appearing here? That is because you know that we did not take all the we did not take that we did not capitalize it before. You know, normally I told you that for this R&D, we did not, there was no figure for it here. So assuming there was a figure for it here, we would have added that one back, amortize it, and then bring the balance to your balance sheet. But if you check the solution that we have here, we only look for this portion, because if you check the R&D, look at what it was about R&D. You have to be very careful. It told us that research and development is not capitalized in the account. That is, we do not take it to balance sheet. It relates to a new project that will be developed over 5 years and is expected to be a long-term benefit of the company. 2020 is the first year of this project. So it is not capitalized in the account. Is the reason why we are not bringing it to this working capital adjustment. I am saying this because when you start doing your private study, you need to say, but this man did this thing like this in that command. Why is he not doing it here? Yes, I am not doing it here, and I have stated my reason for that. So my working capital is ready. My net asset is ready. My NOPAT is ready. My WACC is what I'm going to compute for now. Okay? So for my WACC, I said computation of WACC, isn't it? Computation of WACC. So please stay with me. I'm almost done. So for my calculation of WACC, I said cost of equity times value of equity. Then cost of debt times what? Cost of debt post-tax times value of debt. Okay? You can just strain your eye a little to just see what I have there. Okay? Let me just hold it and see. Good. So this is our cost of debt post-tax times value of debt. So it's quite simple. So please, what is our cost of equity and what's our value of equity? Let's go and check the question. Who can tell me? What's our cost of equity and value of equity? Cost of equity is 60, Abby. Value of equity is 60. Cost of equity is 18. So just multiply both of them. 60 times 18. So let's go. 60 times 18. They've already divided it by 100 to make life easy for them. Then what's our cost of debt? And what's our value of debt? So our cost of debt, here's our cost of debt. So cost of debt is 6%. Okay, let's go and check our interest of whether it's 6% that is there for P&L. Okay, they just put finance charge, they did not put the rate at the front of it. So that is fine. So they just give us the rate directly in this additional information. So our cost of debt is 6%. So don't forget, you're going to convert it to post-tax, right? That's after tax. So let's convert it to post-tax. 6% times 1 minus tax. Tax is given to us in the question as 25%. So 1 minus tax, that means we're looking at 0.75. That's what it means, 0.75. Then times what's our value of debt? It's the things that I did last time, okay? What's our value of debt? This is our debt value, 40%. So I put in my 40% there, which is this guy here, 40%. So do your mathematics. 1 minus 0.25 is 0.5. So 0.5 times 0.4 times 0.06, you get 1.8. Then 0.18 times 0.60, you get 10.8. If you add both together, that means our weighted average cost of capital is 12.6. Am I making sense now? Just know the 4 things that you need. Cost of equity, value of equity. Cost of debt, value of debt. But just know that the cost of debt, the cost of the debt must be post-tax by removing the tax given to you in the question. The final but not the least step is the compute the EVA. Okay, compute the EVA. So for the EVA, we know that our NOPAT is 412, as we have here. Okay, then our weighted average cost of capital, which is WACC, is as we have here. And our 522.3 is as we have here. Okay, as we have here. Just put everything to the formula. 12.6% of 522.3, you have 65.81. Then 512 minus 65.81, you have 24.6. Can anybody explain the meaning of this negative 24.6? Can anybody explain the meaning of this negative 24.6?
Okay, in simple words, it means the company is not creating value
Good.
to their shareholders, or they are not adding value to their shareholders.
So they have made a loss of about 24.6, Abi.
Yes.
Okay, thank you very much. Ladies and gentlemen, this is all we can do as far as EVA is concerned. My appeal is that you are able to go back to your past questions, okay? Go back to this video as well. Watch this video, no matter how long it may be. Watch the video one more time, jot down important and salient points. Then solve several questions as it may be in your past question guide, and that will help you even beyond ICAN examinations, right? So ladies and gentlemen, I remain Dr. President. Thank you so much for staying.